Rajiv Batra is with us. He's head of Asia and co-head of Global Emerging Markets Equity Strategy. Is joining us right now at JPMorgan. Rajiv, good morning. Great to have you back on the program. Thanks very much for joining us. There is always something new, and over the last 7-8 days, it's been software stocks, right? Absolutely pummeled in the US and, of course, here in India as well. For the JPMorgan IT analyst here, of course, has put out a note saying, well, valuations are screaming deep value. What is your perspective? Because you look at other markets as well and developments which are happening, not just in one country or one market in that sense. Is this a space which continues to get disrupted, upsides capped, maybe downside capped as well now after the correction? Or you think there is money to be made here? We just had someone from Macquarie saying that, time to buy aggressively some of these names, and he expects PE to re-rate upwards when guidance for F527 is put out.
Thanks, Prashant, for having me. So I will say not just last 7 days, for the last 2 weeks, we are in a momentum drawdown phase across global markets. And in that, some of the favorite names you can say AI beneficiary, AI adapters, everyone have gone roll through. We have seen some bit of an impact in other asset classes also, like gold and silver, in this momentum drawdown, which we were going through. Along with that, the only space which have seen a benefit was a bond market in global terms, where we have seen US 10-year has come down. But beyond that, everything is beaten down black and blue. Now, one interesting thing which we have seen is that last 2 weeks, not just, you can say, software companies or the companies which are going to be disrupted by AI, that have hit in quite badly, but also your hyperscalers and even AI beneficiaries are getting a hit over here. So what is the root cause beside the drawdown of momentum, the technical side which we are seeing? Root cause number one, market have not started, you can say, giving pat on the back or started talking highly about any hyperscaler who are giving you new capex per se. Whereas markets wants to show, or price momentum wants to show, that if you are talking about adoption or if you are talking about higher use case and earnings, I will give you a benefit per se. Worrying about that now the next leg will be more about how quickly you adapt people on the new AI model, or how you quickly keep on increasing earning. That's where the worry has started coming on the disruptive industry like software and another, that if my LLM models guys start increasing adoption at a cheaper rate, be it US and China, where this company will go for and hiding. So definitely price points have started looking on 10-year, 15-year exercise per se. But the question marks emerges, what is sustainable growth rate? What is a terminal growth rate? Now, we can see people have put estimates around 4% terminal growth rate, 0% terminal growth rate. But the question remained, nobody has a certain answer towards that. It's something similar which India has seen back in 2012 and 13, where the whole global markets was going through e-commerce, or you can say internet enigma, and India lacked name. That point of time again, the disruptive industries were going through massive valuation derating. It was, remember, a 6 to 7 year long cycle. Interestingly, that point of time also, my IT names were trading at a PE of around 14 to 15. Today, despite correction, they are trading at 19 P. This year, I'm talking about MSCI India IT sector. And top of it, the hope of earning growth, which you were highlighting, are still very high, saying that 2026 calendar year earning growth will be 11%, 2027 will be 8.5. But the proof lies in the final answer. We have just seen 1 quarter result gone through. MSCI India IT earning growth was only 2%. Now at a 19.5 P, you give me 2% earning growth. PEG ratio is not at all sustainable for me. So rather than worrying about a valuation, we need to think about growth. And in case, if looking at, okay, the valuations are 10-year average, and we are trying to entice investor on that side, we are just simply bringing them into a valuation trap. So that's what I will try to avoid, and I will look into history, and history shows there is still a substantial downside even from here on.
Avoid IT, still substantial downside left in the tech majors. Spotify recently said, right, their best coders have not written even a single line of code since December. And the pace of change that we've seen is remarkable. It's impacting not just the SaaS software companies, but realty, health, wealth managers, legal tech. Across sectors, you can see that ripple effect. But Rajiv, let me go back to the first line that you said, that we're seeing a momentum drawdown across global markets now. We've seen that now for a fortnight. Do you think that can continue, just given where we are globally in terms of valuation, the kind of run-up that we've seen? Is there a risk that global markets itself go through a bit of a slowdown, and how will the impact be on India?
Thanks, Rima. Good question. I will say that when we look at the historical cycle and analysis, it's usually a 2 weeks, a kind of a median period where there have been momentum drawdown C. And that largely 2 weeks median period was getting over or got over on Friday last week. But if we look at max and min ratio, maximum drawdown period have been even for 4 to 5 weeks also. So taking that into account, you can say we have crossed the median threshold, and hopefully we are coming close to an end. And we have seen that the most recent data point, CPI from the Fed, was not concerning. And what people usually forget, that Fed goalpost is generally not just unemployment and inflation. The third goalpost is also asset pricing. If the ongoing disruption in asset pricing keep on continuing, maybe the policymaker may start reacting too. So taking all these factors into account, and most importantly, earnings have not been bad at a global level. We have seen earnings at US, in Europe, and in emerging market too. Earnings are coming at really, really good pace and justify this valuation. But the concern always remain what will happen 12 months from now. And that's where AI comes into picture. And you can say not just disrupting a typical software, but across the global sectors and industry at this juncture.
Okay. Hi, Rajiv. Good morning. Good to see you in. Earnings season hasn't been too bad, right? Particularly for the broader markets. That's at least what most reports indicate. And the hope is that quarter 4 is better. Nothing wrong in hoping, right? But there are signs that quarter 3 was actually some kind of basing out. My question to you is, what about the FIs? The flows have been mixed. They give us hope on some days, and then, in fact, you have a big $1 billion of sell number like we saw on Friday. Given that earnings is coming back, and as you had pointed out in our last conversation, you were pointing at stability in the Indian rupee. That's precisely what's happened, actually. From that 92-odd mark, it's pulled back a little bit. Do you think things are set for the FIs actually to gradually come back into the Indian markets? They're underweight. They have been selling. And earnings. Will they get attracted?
100%, Nigel. That's what's happening. And ongoing, or you can say just concluded earning season, we saw a broad-based earning growth across large cap, mid cap, and small cap. Remember, last 2 quarters, when mid cap started giving 20+% kind of an earning growth, small caps were still lagging. But this particular quarter, we saw 9% from MSCI India. Then mid cap 100 on MSCI side gave close to around 12% earning growth. And interestingly, small cap is also back, giving close to around 18% earning growth. And remember, this is not just the game of operating leverages and margins only. We saw a very healthy top line also. When we look at MSCI India revenue or top line, growth was around 11%. Beyond earning growth, which is making story interesting for FI, the ongoing correction. So with the ongoing correction, you can see multiple for India is getting further down. If earning supports come along with that, that starts justifying the valuation growth trade-off which India is offering. And remember, most importantly, India risk premia got increased due to geopolitical uncertainty. With India-US trade deal coming through, India risk premia will start getting lower further from here. So taking all these factors into account, plus remember, 9 free trade agreement, which means higher FDI, better exports overall, more like incoming investment on China plus one theme, currency stabilizers and FIs definitely making a comeback. And like right now, we are worrying too much about IT and AI. If this continues at a global level for longer, there are not too many domestic demand hub, which you can say India or China or some of the other Latin America economy offer. They will start becoming a refuge for people running away from tech, AI-driven theme to much more a stable defensive themes in domestic demand world.
Yeah, no, absolutely. By the way, Rajiv, the later this Friday, right, we have once again, potentially a ruling where people have forgotten about tariffs, etc. In the US Supreme Court. Do you think anyone is paying attention to it? Or it's got the potential to surprise? Or it's all done now?
No, definitely people are paying close attention to ruling on the Fed, what is going to happen, ruling on even AIPA over there. But as we can clearly see that even the last time judgment didn't came through, so people don't want to, you can say, play that story well in advance. Everyone is looking for a final decision to come. One decision come either or side, then you can say market price reaction will start happening. But from the past example, people are not playing any trade prior to that.
Thank you very much, Rajiv, for joining in. Great conversation. We look forward to the next one.